from WBRN Radio and on the Bostonred Network. This is the Numbers Man division of our broadcast services. The episode this week in economics on the 10th of March 2019. In partnership with Cranston Analytics, as we normally are. Nonetheless, we'll turn firstly to the global situation, then we'll be back with we'll return to the U.S. situation, job growth, poultry 20,000, and we'll look into it and do a deep dive. But first, let's go to the OECD here and get a little bit of their economic outlook, what is going on here. Let's just hear a little bit of it.
Nice. Uncertainty over China's outlook has also increased. Emerging market economies do resist, but it's largely thanks to easier financial conditions. And most unfortunately, trade uncertainty continues and policy risks are still there. So faced with this, my main message won't surprise you. It will be that governments should cooperate to reduce risks. The longer they wait and the larger the risks for economic prospects. So let me now explain briefly where we stand to start with. Global growth looked really strong in 2017, but it has slowed markedly since then, as you can see from the left-hand side chart. And also from the right-hand side, what you can actually spot is that growth continues to decouple. It remains strong in the US, even if it's slowing a little. But what worries us a lot more is how much it is slowing in the euro area. So let me get into the data. As usual, you can't see much from the table, but if you look at the handout closely, you will see that nearly all the arrows are pointing down, and that's quite new. And in fact, this time we even had to add a red arrow for large revisions. So there's large revisions in Europe, mostly Germany and Italy, which are dragging the downward revision to the Eurozone. But there's also large revision in Canada, in the UK, and in Turkey. So why are we in this position? Well, as I was saying, first, trade. Trade continues to drag us down. Trade growth has slowed further. It was 5.25% in 2017. It's now down to, it was 4% in 2018. And what you can see from the right-hand side chart is that more slowdown is expected. New orders are pointing down in East Asia, and they're pointing down in Europe. And when we zoom on the euro area, it's even more dramatic. That's on the left-hand side. Trade growth has fallen sharply and is now 0. And that's true for external export growth. It's also true for intra-euro export growth. If I just give you a little number, it's quite important to look at both intra and extra-EU growth, because intra growth is about half of total good exports of the Eurozone. Now, let me move to one of the themes which is underlying this projection, which is confidence. And when I say confidence, I should say undermine confidence. And that's behind a lot of this projection. The very unusually high uncertainty, policy uncertainty, is leading to a sharp decline in confidence. And you can see that for both business and consumer on the left-hand side. And as a result of this, firms are planning to hire less workers. This has been the case for the UK for a while, and that's largely due to Brexit, but it's more recently the case for the Eurozone. And with growth significantly weakening, job creation in the Eurozone could halve to 2 million in 2019-2020, when net job creation was about 4 million in the 2 years running into 2018. So this has a massive impact on job prospects, and it's all the more worrying that the labor market was really well recovering and wages were starting to pick up. So with the stage set up, let me now turn to the risks. And first, slower growth in China. As you know, China has been the largest contributor to global growth for the past 2 decades, so that any sharper deterioration would cascade to the rest of the world. So what's the big risk with China? If we look at it just through the trade channel, so in quiet and mechanical way, and when we simulate about 2 percentage points less demand growth in China, then we have a reduction for global growth of about 0.4 percentage point, which is sizable, and that impacts firstly East Asia, commodity exporters, and Japan. But you know that economics is not pure trade accounting, and we've put a lot of emphasis this time and last time on the role of confidence. So what we have done here is take into account how much a slowdown in China can hurt confidence. And when we factor that in, and that's the green block, then what we see is that the impact of a slowdown in China could be 2 to 3 times higher for Japan, for the euro area, and for the US. So in one word, if China sneezes, we could all catch a cold. Let me now move to the second risk, which is credit growth weakening in Europe. As you can see from the right-hand side, credit growth was going through a period of real buoyancy until early 2018, but this has faded away. You can see that it's stabilizing in France, but you can also see that it's declining in Spain and in Italy. So part of it may be demand-driven, part of it may be that because growth is slower, then there's less appetite for credit, but part of it may also come from uncertainty. And when uncertainty raises government bond yields, for example in Italy, then it obviously makes the cost of banks funding and therefore credit more expensive. So whether it's demand or supply driven, should credit weaken further, this would add another headwind to euro area growth. And of course, there is Brexit. So there we can now see the real cost appearing, and I will take you in a couple of minutes through those charts. Look at the left-hand side chart. Compared with the projection that we made in 2016, just before the referendum, and this projection is the dotted red line, we had the realization of UK GDP growth is the plain red line. So you can see that compared with our projection, there's about 0.7% of GDP missing. But this was only projection. Another way of looking at it is to see how much other similar economies have increased over the same period. And if we take as a benchmark Germany, France, and the United Kingdoms, which are and the United States, which are probably the 3 most similar economies to the UK, then we can see that UK GDP has increased much less than these 3 countries. And we're missing about 1.7% of GDP growth, of GDP. And why is that? Well, uncertainty linked to Brexit has obviously had a marked impact on investment. What we see on the right-hand side is how much investment has grown in the UK compared with the rest of the OECD. And what's particularly striking is that since the beginning of 2017, we had virtually no investment growth in the UK. So all the uncertainty linked around Brexit.
And we'll leave the presentation here. What we will do, we will append this entire OECD presentation there, the economic outlook and interim economic outlook. And there you can download the presentation, also the handouts, so it gets to be a bit handy for one to look at. Let's now go to the U.S. The reason we started outward because of Europe and the U.S. and China being very important trading partners. And what she was talking about, the speaker, is basically the psychology of the market. Now, because of a lot of uncertainty in the UK with Brexit, if those have been following that from the political side, it was a referendum to leave the EU. Now is March, and it will expire in a few weeks here that they have to leave. They can make a hard Brexit or whatever, but the EU is not poised to accommodate the right-wing or Tory government of the Prime Minister May in the UK. So it's causing all sorts of problems. Some of the banks have already moved their headquarters from the City of London to other locations. The amount of investment in the UK has been less because of the uncertainty there in the UK. And also look back to over the last, say, 10 years, the UK economy has not been that strong since the Depression, and that's what it's called in the UK. In the US, we hear the word Great Recession. That's just quibbling. So we'll call it a depression, but in all of Europe, you look at Italy, an important trading partner for the US, Spain, etc. Some of those economies were coming out, including France, but now there's difficulty in France with employment situation there, with austerity, with the protests in the street, in its, I believe, 17th week that the protesters have been out there, and Gilets jaunes, and nonetheless, so it is in an economic turmoil. And then we look at the uncertainty surrounding sanctions covering the petrol market in Iran. That has already taken place, so they are off the line. And what is happening in Venezuela, the continual sabotage there and the coup attempts in Venezuela. Their production had been down, and now because of the sanctions, the U.S. Further down, and wherever that would leave production. I have noticed a little anecdotal evidence here. If we have time, we'll check into the gas buddies or whomever, but the cost of petrol, gasoline within the U.S. has been going up. We'll go to some of the latest information here from the U.S., the employment situation, and then we'll look at the beige book from the Fed, and we will attach all of these. We won't go through the whole scenario. We'll just hit the, as one would say, the highlights. Nonetheless, this is for February, and the total payroll changed little in February. A plus 20,000. The rate of unemployment or redundancies for the world at 3.8%. That's from the Bureau of Labor Statistics. Now we first go to the household survey. The unemployment rate declined 0.2% to 3.8% in February. The number of unemployed persons decreased by 300,000 to 6.2 million. Amongst the unemployed, the number of job losers and persons who competed for temporary jobs, including people on temporary layoff, declined by 225,000. This decline reflected in part the return of federal workers who were furloughed due to the shutdown. Amongst the major work groups, unemployment rates for adult men was at 3.5, for Europeans at 3.3, for Latinos at 4.3, decreased in February. The jobless rate for adult women at 3.4%, for teenagers at 13.4%, for African Americans at 7%, for Asians at 3.1%, showed little or no change over the months. The long-term unemployed, those jobs, roughly 6 months, 27 weeks, was essentially unchanged at 1.3 million, accounted for 20.4% of those that are unemployed. The labor force participation rate at 63.2% in February, had little changed over the year. The employment population ratio at 60.7 was a little unchanged over the month, but was up 0.3% over the year. A number of persons working part-time for economic reasons decreased by 837,000 to 4.3 million in February. The decline follows a sharp increase in February. It may resulted from the government shutdown. And one thing to look at, these figures, they will be revised because the Bureau of Labor Statistics itself was on furlough. In February, 1.4 million persons were marginally attached, a decrease of 178,000 from a year early. This is not seasonally adjusted. Individuals were not in the labor force, wanted or were available for work, or had looked sometimes in the past year, 12 months. Amongst the marginally attached, there were 428,000 discouraged workers. That's almost 500,000, little changed from a year earlier. The establishment survey, the other survey here, the non-farm payroll was little changed. In February, again, the 20,000 after increasing by 311,000 in January. In 2008, job growth averaged 223,000 per month. In February, employment continued to trend up in professional and business services, wholesale trade, while construction declined. We could expect that to happen in February. Employment in professional and business services trended up 42,000, in line with the monthly average gains over the last year, or 12 months. Healthcare added 21,000 jobs in February and 361,000 over the year. Employment ambulatory healthcare services edged up over the month, 16,000. Wholesale trade employment continued to trend up, 11,000 there. The industry has added 95,000 jobs over the year, largely amongst durable good wholesalers. Employment in construction declined by 31,000, partially offset by an increase in February. That's very unusual. This number is very unusual. 53,000 in February. Employment declined in heavy and civil engineering construction at 13,000. Over the year, construction added 223,000 jobs. That in itself is a little bit phenomenal, but we've heard anecdotal evidence out of the state of Colorado. In Denver, the cranes are up, building offices there. This article was on their Canvas legislation in the state of Colorado, I believe since 2012. The cannabis are marijuana has been legal, and this is the trade and the taxes brought in from it. Manufacturing employment changed little in February. 4,000 people added, an increase of an average of 22,000 per month over 12 months. Employment in leisure and hospitality was unchanged after posting 89,000 and 65,000 in January and February respectively. Over the year, leisure and hospitality added 410,000 jobs. Employment in other major industries, mining, retail, transportation, information, warehousing, etc., showed little or no change. The average work week for workers decreased 1/10 hour. to 34.4. In manufacturing, the average work week declined by 1/10 to 40.7 hour, while overtime was unchanged at 3.5 hours. The average work week for production workers fell by 3/10. They use the word non-farm, but this is a carryover from many years in the back. The average hourly earnings for all workers rose 11 cents to $27.66, following a 2-cent gain in January. Over the year, an average hourly earnings has increased by 3.4%. Hourly earnings of private production workers increased by 8 cents to 23.18. The change in employment for December was revised up from 22,000 to 27,000. The change for January was revised up from 304,000 to 311,000. These revisions, gains in February and January combined were 12,000 more than previously reported. Not unusual to underreport because of the difficulties that they had. After, the estimated recalculation of seasonal factors, after revision, job gains were 186,000 per month over the last 3 months. The next report will be on April the 5th, 2019. Let me just look at a couple of little things here before we get to the beige book. U.S. households see biggest decline in net worth since what they term the financial crises. Household net worth fell at the highest level since the crisis. Net worth at the end of 2018 was $104.3 trillion. That's a drop of $3.73 trillion for the third quarter. Americans' net worth fell at the highest level since the financial crisis in Q4 of 2018. As the sliding of stock prices into household balance sheets, net worth dropped $104.3 trillion as the year came to an end, a decrease. We already said that. But you start to see the numbers here. In 2008 Q4, the loss was 6%. In 2008, was 6%. In Q4 of 2018, it was 3.5%. I'm giving the percentages here. And in 2011 Q3, it was 3.4%. Now, Q4 of 2008 was in the depression, so 6%. So it's fairly large there. Percentage loss. So their household net worth has been rising strongly since the depression, up 23% since 73% since 2009. After suffering their worst Christmas Eve in history, stocks again staged a turnabout and ultimately saw their best 2 months since 1991. The Dow average is off about 1.6% in March, still up 9% over the year. The fall in net worth came after during a quarter when the GDP rose 2.6%, according to the first estimate. That was part of a year that showed growth at 3%, despite lackluster financial markets there. Economists, this is from incidentally CNBC, economists expected a little growth to start with little growth in the economy. The Fed sees growth up, this is the Atlanta Fed, at 0.5%. So this is basically what you see here. Let's get to the beige book. This is out by the Federal Reserve. And this is February here, and this is all of the districts in. We talked about what the Beige Book is. It's a report of the 12 federal districts across the U.S. We'll just give the national summary, and then we'll go to the Northeast. Anyway, the Federal Reserve Bank of Boston. Economic activity continued to expand in late January and February, with 10 districts reporting slight to moderate growth. Philadelphia and St. Louis reported flat economic conditions. About half of the districts noted that the government shutdown had led to slower economic activity in some sectors, including retail, auto sales, tourism, real estate, restaurants, manufacturing, and staffing services. Consumer spending activity was mixed across the country, with contacts from several districts attributing lower retail auto sales to the harsh winter conditions. Again, climate comes in here. To the higher cost of credit, manufacturing activity strengthened on balance, but numerous manufacturing contacts conveyed concern about weakening global demand. We just covered that, and that was the reason to do that. We wanted to work from the whole out into the center. Activities in non-financial sectors increased at a moderate pace in most districts, driven in part by growth in professional, scientific and technical services. Subdivision residential construction activity was steady and slightly higher across most of the U.S. That's very unusual for winter, but residential home sales were generally lower. Several real estate contacts noted that inventory had risen slightly but remained historically low. Employment and wages. Employment increased in most districts, with modest to moderate gains in the majority of districts, studied to slightly higher employment in the rest. Labor markets remain tight for all skill levels, including notable worker shortages for positions ranging from information technology to manufacturing to trucking to restaurants and construction. Contacts reported labor shortages were restricting employment growth in some areas. Contacts in the higher education sector from the St. Louis district indicated fall enrollment in potential students were increasing, and this happened in other districts also. Chose to enter the labor market continues to increase for both low and high skill positions across the nation. A majority of districts reported a modest wage heights. In addition, contacts in about half the districts noted rising non-wage forms of employee compensation, including bonuses, relocation assistance, vacation, sign, and flex there. Now, to give some of the highlights here, Boston retail and restaurant industry reported continued growth in sales. Most manufacturing cited sales increase, but some said sales were down from a year earlier. Staffing firms also reported revenue decline, which they attributed to the tight labor market. In other words, if workers are not out there, they can't find them. Some retailers reported price increases aside from manufacturing. Outlook remained positive. Over to New York. Activity increased slightly in the latest reporting area, while labor market remains tight. Pickup for input cash rose at a steady pace, while selling prices accelerated slightly. Consumer spending weakened, while the housing market were studied to slightly softer. Most sectors saw modest growth. Banks reported weaker loan demand. Down in Philadelphia, on the balanced growth of aggregate, the third district activity appeared to poise during the current Beige Book. Most sectors showed little or no change from the prior period. Lack of qualified labor continues to constrain hiring and raise wage pressure while prices remained modest. Needlessly, firms remained generally positive. That's to outlook. Over to St. Louis. Activity was unchanged from the previous reporting area. Manufacturing activity continued to improve at a modest pace. District bankers reported slight decrease in loan volume in the first quarter. Residential real estate contacts reported that recent sales had fallen below expectations. Local farmers expressed concern regarding the near-term status of the industry. In Cleveland, the debt district grew at a modest pace. Seasonally adjusted factors temporarily weighed on growth in construction and freight. Employment increased modestly in many sectors. Wages grew modestly across the board. Selling prices rose modestly. A drop in mortgage rates spurred slight improvement in home sales in Minneapolis. In the 9th district, activity growth was modest. Labor demand remained healthy, but signs of weakness surfaced. Price and wage pressures were moderate. Consumer spending offered a mixed sign on economic activity. Manufacturing industry and mining activity grew, but agricultural conditions continued to deteriorate. No changes expected in the coming months there. On to Richmond. On balance, the region's economic expansion expanded at a modest pace. Port activity, trucking, and tourism were generally increased at a modest to robust pace. Labor demand strengthened modestly. Overall, manufacturing, retail, and non-financial services gave mixed accounts. Some retail and professional business services in and around D.C., this is Richmond in Virginia, they cited delays and lost activity due to the shutdown. In Kansas City, consumer spending increased slightly with gains in real estate, restaurant, auto, tourism sales, manufacturing, wholesale trade, transportation. Professional and high-tech firms also reported rising activity. However, residential real estate fell modestly. To Atlanta, the district's labor market remains tight. Wages increased. Non-farm input costs continued to rise. Retail sales were flat. Tourism was robust. Home sales continued to slow. Commercial real estate was steady. Manufacturers noted new orders were flat. In Dallas, expanded modestly with slight pickup demand seen across manufacturing, service, and housing sector. Drilling activity dropped. The hiring continued at a modest pace. Employment outlooks were bullish. Input price pressures moderated, but the wage pressures remain elevated. To Chicago, employment and business spending increased slightly. Manufacturing, construction, and real estate activity were a little changed. Prices rose slightly. Financial conditions improved modestly. Contacts expect crop income to be lower in 2019 than 2018. On to San Francisco, that's the 10th district. Labor market conditions remain tight. Price inflation was unchanged. Sales of retail expanded modestly. Activities in consumer and business services were strong. Conditions in manufacturing sector strengthened modestly. Activity in real estate markets expanded modestly on balance, and overall activity, lending activity was flat. Summary of activity. The first district, from the first district, indicated that activity was somewhat mixed, and the latest report, retailers reported modest, this is a summary here, increase in sales, and restaurants were also up. Manufacturing results, by contrast, were varied, and half of this round respondents cited decline in sales revenue in a market slowdown. Marked slowdown in price growth, the pace of growth. Staffing firms also reported revenue decrease, largely attributed to shortfall of candidates in a current tight labor market. Commercial real estate was similar, slightly improved since the last report. Manufacturers say they were cautious about 2019. Business contacts said the labor market remains tight, but wage pressures continue to moderate. Beyond a shortage of workers in certain skill categories such as information technology, retail, respondents reported no real problem filling job openings. Depending on the local labor market conditions, some retailers reported seeing a higher wage costs. Incidentally, Costco is raising all of their workers to $15 an hour. And this will put pressure on some of the others, the Best Buys and the Targets of the world there. And also Walmart. 3/4 of manufacturing contacts reported continuing to hire at their normal pace. None cited unusual pressures. Prices were mixed. Retailers said price declines for certain food categories had slowed down, and grocery categories saw price increases. I can vouch for that one. A prominent big box retailer reported that some consumer goods manufacturers announced plans to raise prices by 7% to 10% when the cost increase passed through to retail prices, depending on when contacts with individual retail chains are renewed. Contracts, sorry about that. We won't go into retail, their summary here. We'll append this. And let's see what else we got. Staffing in New England, we already talked about that. Negative single-digit revenue growth for the year 2018, regardless of the industry placement types. All respondents cited low unemployment rates and limited application supplies as challenges to their business, and on helping numbers requests from clients. A few staffing firms said the tight labor market made it possible to raise rates with no pushback from clients. Most firms reported ongoing work to strengthen the relationships with community groups and advertise for candidates on social media channels. The shutdown created uncertainty amongst client organizations who were less willing to make hiring decisions near the end of 2018. Commercial real estate heading into 2019. Commercial real estate market in the first district reported a slowdown in sales, and sales decreased there. We're in the first district here. And so basically the summary in the second district has increased slightly since the last report. We won't go over all these districts. We can just append it, and you can look up your favorite district in New York, and we just finished Boston. And Philadelphia, Cleveland grew at modest pace in Cleveland. And Richmond, that's outside of D.C., pretty much there. Atlanta, economic activity continued to advance at a modest pace, and this is basically non-labor costs continue to rise. We see some inflation build in all these districts. In Chicago, that's the 7th district, increased slightly on the balance in January and February, though contacts expected growth to return to a modest pace over the next 6 to 12 months. That's out in Chicago. St. Louis, you probably wage increase at modest rate. Survey respondents reported a slight increase in price change to consumers. Reports on consumer spending were mixed. Manufacturing activity continued to improve in that area. Overall, amongst contacts, continued to weaken for the fourth quarter consecutively, but remain optimistic. And in 2019 to be better, somewhat better than 2018. That's interesting there that that is out there. In light of the other information that we put forward. In the upper Midwest, they're growing modestly there. This is in Minneapolis area. Wage growth rose slightly overall since the last report. Recent job posting data, December, January, depending on the state, were mixed. North Dakota and Montana both showed a healthy increase in job postings, but declines were seen in Minnesota, South Dakota, and the Upper Peninsula of Michigan. So that is pretty much the state, as one would say. I think we pretty much got over most of it here, and yeah, we're running over, about our normal time. To sum all this up, we're seeing a global decline, whether it be from China or across Europe, Brexit there, a lot of uncertainty involved in it. In the U.S., the jobs report, 20,000. The administration had very little to say about that. But if you look over the average, roughly around 200,000 jobs are being created, a little more than 200,000 jobs. Takes about 300,000 to pull out the slack. The slack has went down. And in some districts, what it basically means, you could, nationally 3.8% basically overall percentage. In some other districts as low as 3%. The available pool itself narrows, so thus some of the states are not reporting the job numbers because simple reason they're not candidates out there, or if the jobs are offered at such substandard rate, they're usually just pulled off the market and not filled. So some people going to say $15 as their floor to get qualified candidates. Well, how many qualified candidates are out there? Well, one has to see on that and what the baby boomers do. We're talking about basically people 55 to 60 to about 66. Especially the 60 to 66, a lot of those people are sticking around. Some of them are being brought back in because simply the candidates are not there with the experience. And the level of experience for many of these candidates went down. At one time, you'd look at, say, 5 years experience, 4 years experience. Now, perhaps it's 3 years. That's the duration that some people are at one particular workplace. Thus, a candidate out of a university or whatever that has zero experience will be hired at probably a lower level, but once that candidate receives even 12 months experience, 24 months, they have usually started to move on, as long as the job environment as is. So that's one thing to look at for the job environment, actually where you are. Pricing, inflation itself, we at this mic feel that unless something happens spectacular, there should at least be one or two more rate increases because of the rise, particularly in consumer goods and in food staples, that sort of thing. That inflation has eaten up the discretionary income that people have. Very, very tight, because things like rents, in Oregon they have a new rent control law out for the state of Oregon. But this situation, especially rents and mortgages, Alexandria Ocasio-Cortez was talking about that, and you can find hers at a presentation at Tic Tac. That's Bloomberg's the entire hour and something. And on some of our channels for International Women's Day, we will replay that audio. Very well thought out presentation. Hers was the most popular one on Saturday. You have some of the presidential candidates there. They talk about such things as Medicare for all, the new green economy, and she frames that in the proper perspective. We won't get into it now because it's a future. It's not in macroeconomics today. But what is in macroeconomics is that usually in economies, at least since we've been in the game, there's a tendency for things to stabilize. We're talking about the rate of unemployment. All right, we have an outliner like we did in January 300 something thousand jobs being created. That usually doesn't happen. Down to 20. That is a bit suspicious in itself. But sometimes when you have these exaggerations, and in the end, some of the revisions came out a little better than normal. But what we want people to look at is not outliners, not gains, but what is over the course. Now, there is negotiation, supposedly 24 hours a day with China. That won't have much to do with it if China is, actually their economy dropped by over 20%. So in other words, if China's overall economy is dropping, they will be buying less. And if other economies drop, this is a global situation, the U.S. would be importing less. And at the same time, demand there for things like petrol, and we'll look at that in a minute here because we haven't looked at the markets. We'll go to the BBC and do that very quickly. But these things are all tenuous, and this confidence game in the U.S., the shutdown did not help confidence at all because businesses like normalcy. They don't want to think about things. But when any trend, as in the global trend now, they understand that the global economy is in decline in China and in the EU, etc., there will be a certain amount of normalcy, at least in the psychology of the market. Now, the Dow had been extraordinarily up, and now it had a correction during the Santa Claus correction, and now it is up there. But this is very, very tenuous. So you can expect them to have bad days. They dropped 200%. So these up and down days are coming. We'll get over here to the BBC very quickly and wind up our report. And plus other global situations such as tornadoes, they feed into it. Let's go first to the FTSE. The FTSE was down 0.74. That's the FTSE 100. In Amsterdam, they were down 1.14%. In Paris, they were down 0.70% in the negative there. In the DAC was down 0.52%. The Stasi, was down 0.76. In Madrid, they were down 1.30%. And to Bombay, they were down 0.15%. The Hang Seng in Hong Kong was down 1.91%. And Nikkei was down 2.01%. Back to the U.S., the Dow was down 0.09%. And the Nasdaq down 0.18%. And in Chicago, they were down 2.1%. And let's go to commodities. Brent crude futures at $65.74 was down 0.84% there, and West Texas Intermediate was at $56.04. It was down 0.4%. That T-bone picking is still jumping for joy. The Forex, what do we have there? Gold was changed by 55 cents at $1,885.30. And I think this is all we have for the numbers here. Yeah, this is all we have. So the markets go along. Little adjustment there, not a lot of adjustment we have. This will do it for us. We'll have to finally get in. We haven't had the Fed Chair Jerome Powell. We'll have to come up with something for his Humphrey Hawkins report. We'll make it a special presentation on the Numbers Man channel and talk a little bit about it because it is still relevant, and perhaps we'll sum up some of the beige book. Nonetheless, for those in business, have a productive week. For the consumer, your eyes are on the prize. Incidentally, the dollar store and whatever the other money tree, they have combined. They're closing 300 plus stores. I suppose the the Payless Source, or whomever they call themselves, shoe enterprise has closed their stores or in the are liquidating this month. So a number of things there, retailers liquidating, etc. across the board. Have a good week.